Most people believe the biggest money in intraday trading is made during the first few minutes after the market opens. If you've heard that before, you might be heading toward the same mistake I made when I first started trading. Every morning, I would sit in front of my screen waiting for the opening bell. The moment the market opened, I felt like this was my chance to make the biggest profit of the day. The first candle would move quickly, my heart would race even faster, and I convinced myself that if I didn't enter a trade immediately, I would miss the opportunity of a lifetime. Years later, I went back and reviewed thousands of trades from my trading journal. What I discovered completely changed the way I looked at the market. I realized that I wasn't making my biggest profits during the time everyone talked about. Even more surprising, my biggest losses weren't caused by a bad strategy. The real problem was something I had completely overlooked. Today, if someone asks me when the most profitable time of day is for intraday trading, I never answer with a specific hour. If I simply gave you a time, you would probably repeat the same mistake I made for years. Before you search for the perfect trading window, you need to understand something much more important. The market doesn't offer quality opportunities every hour. Some periods provide clear setups, while others are designed to test your patience. Most traders never learn the difference. When I first started trading, I believed the more time I spent staring at charts, the more money I would make. From the opening bell until the closing bell, I barely left my chair. Every new candle looked like a fresh opportunity. Every breakout seemed profitable. Every pullback looked like the perfect entry. At the time, I believed that professional traders spent the entire day watching the market. Eventually, I realized I wasn't studying the market at all. I was watching my own emotions. If my first trade was profitable, I became overconfident and believed the rest of the day would be easy. If my first trade ended in a loss, I spent the entire session trying to win that money back. Without realizing it, I was following my emotions instead of following price action. That realization marked the beginning of everything that changed. Instead of searching for another indicator or another strategy, I decided to study something I had ignored from the very beginning: my own trading behavior. The answer I found wasn't hidden in the charts. It was hidden in the timing of my decisions. The next day, I made a simple promise to myself: I wouldn't learn another indicator. I wouldn't search for another trading strategy. Instead, I would study every trade I had already taken. I opened my trading journal and wrote down one detail beside every single trade: the exact time I entered it. At first, it seemed like a pointless exercise. I didn't expect it to reveal anything useful. But as I continued reviewing months of trades, a pattern slowly began to appear. There were certain times of the day when my decisions were calm, patient, and well-planned. Then there were other times when I became rushed, impulsive, and eager to force trades that didn't really exist. The strange part was that sometimes I had an excellent setup, but the timing was wrong, and the trade failed. Other times the setup was nothing special, but because the market conditions were right, the trade worked almost effortlessly. That made me ask a question I had never considered before. Does strategy make money, or does the right mindset at the right moment make the difference? I didn't know the answer yet, but I knew one thing for certain. Spending the entire day in front of the screen was not the same as having opportunities throughout the day. A few days later, I was talking with a veteran trader who had spent decades in the market. He asked me one simple question: how many hours do you trade each day? Proudly, I answered, from the opening bell until the market closes. He smiled and asked another question: and during how many of those hours do you actually make money? I didn't have an answer. The truth was obvious. I traded all day, but nearly all of my profits came from only a handful of trades. The rest of the time, I was simply sitting in front of my screen, searching for opportunities that weren't there. Then he said something I'll never forget: a professional trader doesn't work all day. A professional trader is fully present only when the market gives them a reason to be. At the time, I didn't completely understand what he meant, but on my way home that evening, I kept thinking about those words. If my profits weren't coming from the entire trading session, why was I trying to trade the entire session? That question changed everything. For the first time, I realized that success in intraday trading isn't about finding the perfect hour on the clock. It's about recognizing the moments when your mind is calm enough to make good decisions instead of emotional ones. The following week, I decided to test that idea with one simple rule. I would stop reacting to the market the moment it opened. Instead, I would learn to wait. That rule sounded simple. Following it was one of the hardest things I had ever done. The moment the opening bell rang, the market exploded with activity. Stocks moved sharply in both directions. Financial news was full of excitement, and social media was flooded with predictions. Everywhere I looked, people seemed certain they already knew where the market was going. My own mind kept repeating the same thought: enter now, or you'll miss the move. Looking back, I realized I wasn't reacting to the market. I was reacting to the crowd. The more excitement I saw, the more pressure I felt to take a trade. So instead of trading, I started observing. First I waited 5 minutes, then 10. Eventually, I forced myself to wait 15 minutes before even thinking about entering a position. What I discovered surprised me. Many of the stocks that looked incredibly strong right after the open became some of the weakest just 20 minutes later. At the same time, stocks that barely moved during the opening minutes quietly developed into the cleanest trends of the day. For the first time, I understood that the opening bell doesn't reveal the market's true direction. It reveals the market's emotions. During those first few minutes, millions of traders react to overnight news, fear, excitement, and expectations all at once. Those emotions appear in the form of buy and sell orders. That's why fast price movement doesn't always mean a great opportunity. Sometimes it simply means uncertainty. I still remember one particular morning. The global markets had been strong overnight, and every headline sounded bullish. The market opened with a large gap higher, and the first candle shot upward almost immediately. Without thinking carefully, I joined the buying. For a few moments, everything looked perfect. My position was in profit, and my confidence kept growing. Then the buying suddenly stopped. Heavy selling entered the market. Within minutes, the entire move reversed, and my stop loss was hit. The loss wasn't what bothered me. It was the reason behind it. I hadn't followed my trading plan. I had followed everyone else. That evening, I wrote one sentence in my trading journal. I didn't trade the chart. I traded the crowd. Those words became one of the most valuable lessons of my trading career. Around 30 minutes after the open, the market finally began to settle down. Volume became more consistent, the strongest stocks separated from the weakest, and the real trend started to appear. That's when I realized experienced traders don't chase the opening excitement. They wait for clarity. Because in trading, patience isn't the price you pay for opportunity. Patience is often the opportunity itself. A few days later, I decided to test a new approach. I stopped judging the market by its first few minutes and started paying attention to what happened after the initial excitement faded. Around 9:45, I noticed something interesting. The market became calmer, price movements looked more organized. Volume stayed consistent, and the strongest stocks began showing their real direction instead of reacting to emotion. One morning, I watched the entire opening session without taking a single trade. It wasn't easy. My hand kept reaching for the mouse. My mind kept telling me to jump in before the opportunity disappeared. But I waited. Around 9:40, one stock slowly broke above its trading range. This move was different. It wasn't explosive. Buyers stayed in control, volume continued to build, and price respected the trend instead of reversing every few minutes. I finally entered the trade. It wasn't the biggest winner I'd ever had, but it was one of the smoothest trades I had ever experienced. For the first time, I wasn't chasing the market. I was trading with it. That day taught me something no indicator ever could. The best trading decisions don't come from excitement. They come from clarity. I also realized that the most profitable trading window isn't determined by the clock. It's determined by your state of mind. If you're driven by fear of missing out at 9:20, then 9:20 is the worst time for you to trade. If you're calm, patient, and able to read the market clearly at 9:45, that becomes your best trading window. For a while, I believed I had finally solved the puzzle. I had stopped chasing the opening move. My entries improved. My results became more consistent. I thought my biggest problem was behind me. I couldn't have been more wrong. The toughest challenge wasn't waiting for the right entry. It was knowing when to stop trading. That lesson was waiting for me later in the day, during the quiet hours when the market slowed down, but my emotions didn't. One morning, I found a perfect setup around 9:45. The trend was clear, volume was strong, and price kept moving higher with very little resistance. I entered the trade, and within 30 minutes, it reached my target. I locked in the profit and felt great. At that point, I could have closed my laptop and walked away. Instead, I stayed. That was my mistake. By around 11:20, the market had changed. The momentum that drove the morning session had faded. Candles became smaller. Price moved up, then back down, then right back up again. There was no clear direction. But my mind was still focused on the success of my first trade. It kept telling me, "You're in the zone. Take one more trade." That's one of the biggest traps in trading. Most people think greed only appears after a loss, but confidence can be just as dangerous. I took another trade, even though the setup wasn't as clear. At first, it showed a small profit, then it pulled back to my entry. Instead of exiting, I started hoping. A few minutes later, my stop loss was hit. I told myself it was just one bad trade. Then I took another, and another. By that point, I wasn't reading the chart anymore. I was trying to erase my previous loss. By early afternoon, every dollar I had made that morning was gone. The strange part was that I knew I was making bad decisions. I just couldn't stop. That was the day I realized overtrading isn't always caused by greed. Sometimes it's caused by boredom. When the market becomes quiet, an undisciplined trader feels the need to stay busy. A disciplined trader understands that doing nothing is often the best decision. That lesson changed the way I looked at the middle of the trading day forever. That evening, I opened my trading journal again. This time, I wasn't looking at profits or losses. I was looking at the time each trade was taken. The pattern was impossible to ignore. Almost all of my best trades happened between 9:30 and 11 o'clock. During those hours, trends were clearer, volume was stronger, and decisions felt easier. After that, everything changed. Volume started fading, momentum slowed down. Price moved inside narrow ranges with no clear direction. Ironically, that was when I became the most active, not because the market offered better opportunities, because my mind wanted action. That was one of the biggest lessons of my trading career. The market doesn't create opportunities every minute, but the human mind always wants something to do. When real opportunities disappear, emotions begin creating imaginary ones. That's why two traders can watch the exact same chart. One waits patiently for 2 hours without taking a single trade. The other takes 5 unnecessary trades during the same period. The difference isn't the chart. The difference is self-control. From that point on, I spent several afternoons doing nothing but observing. At first, it felt uncomfortable. I wanted to click the buy button. I wanted to stay involved. But the longer I watched without forcing trades, the more clearly I understood the market. The midday session wasn't testing my strategy. It was testing my patience. That's where emotional traders separate themselves from professional traders. Professionals know they don't have to trade every move. They only trade the right ones. Eventually, I realized something that completely changed my results. The biggest profits in intraday trading don't come from taking more trades. They come from having the discipline to wait until the right opportunity appears and the confidence to do absolutely nothing when it doesn't. The final lesson didn't come from finding the perfect setup. It came from learning when not to trade. Near the end of the trading day, I noticed 2 types of traders. The first group had done very little all day, so they felt they had to take at least one trade before the market closed. The second group had already made good money, but wanted even more. One was driven by regret, the other was driven by greed. Yet both were making decisions for the same reason: emotion. I had been both of those traders. If I was profitable in the morning, I wanted to finish the day with an even bigger gain. If I was down, I wanted one last trade to recover my losses. Either way, I wasn't following my plan anymore. One afternoon, I had already completed 2 successful trades. I could have closed my laptop and walked away. Instead, the market suddenly started moving higher just before the close. A strong green candle appeared, then another, then another. My first instinct was to jump in. I opened my order window. Then I stopped. I asked myself one question. If this exact setup had appeared earlier in the day, would I still take this trade? The answer was no. So why was I considering it now? Only because I was afraid of missing out. I closed the order window without placing the trade. The next morning, I reviewed the chart and realized that decision had saved me from another losing trade. That day, I didn't celebrate making money. I celebrated making the right decision. From then on, I changed the way I measured success. After every trading session, I stopped asking how many winning trades I had taken. Instead, I asked a different question. How many bad trades did I successfully avoid today? That simple change transformed my consistency. The trades I skipped protected my account just as much as the trades I took. Eventually, I realized there is no magical time of day that guarantees profits. Your best trading window is the one where your mind is calm, your emotions are under control, and you're willing to wait for the right setup. The biggest profits in intraday trading don't come from trading every move. They come from having the patience to do nothing until the right opportunity finally appears. That's the difference between someone who trades the market and someone who truly becomes a trader.